Hello, and welcome to Chapter 2 of Financial Accounting for Managers. Chapter 1 was sort of an overview. We're trying to do this without a lot of journal entries, although we will have an exercise or a project due that has some journal entries. But we're going to look at the balance sheet, as you can see here, a further look at the balance sheet. So a balance sheet is one of the four primary statements that we as accountants will produce. So that's our end product. We take all this financial information, all these financial transactions, we collect them, we enter them into a computer system. The computer system will then produce the financial statements that we want, and they can produce a lot of other information as well. But the four financial statements that we produce are the income statement, which basically says, did we make money? The statement of retained earnings, which basically says how much of the money we made did we keep compared to giving it back to shareholders as dividends. Number 3 would be the balance sheet, and this is a list of all your assets, liabilities, and equity. The balance sheet represents the accounting equation. So assets equal liabilities plus equity. So the total number of assets is equal to liabilities plus equity. And again, I use the example of if you buy a house and the house is worth $100,000, that is your assets, $100,000. If you take out a loan for 80% or 80,000, that will be your liability, and that means you'll have 20,000 of equity. So assets $100,000 is equal to liabilities of 80,000 plus equity of 20,000. And then the last financial statement is the statement of cash flows, which provides a lot of good, useful information. We're again talking about GAAP accounting, generally accepted accounting principles. So these are principles that guide us as to how we record things and what statements we produce and what is revenue, etc. So let's look at the balance sheet. We want to identify the sections of a classified balance sheet. So a classified balance sheet just means that we're going to separate things by liquidity, use ratios to evaluate a company's balance sheet. All right, so the classified balance sheet overview presents a snapshot at a point in time. It would be similar to you if you were to produce a personal balance sheet. You would list all of your assets, car, computer, phone, clothes, furniture, house maybe, bicycle, anything that has value, anything that will last for more than a year, or even short-term assets. So if you work and your company owes you a paycheck, that is an asset for you. So you also have liabilities. We'll talk about that. Those are things you own. So if you use a credit card, you have created a liability. You owe the credit card company for whatever you purchased. And equity would be the difference really between the two. So we have current assets, and we divide this into long-term and current short-term assets. Short-term means usually that they can be converted into cash in less than a year. From a liability standpoint, it means that they have to be paid in less than a year, or the operating cycle, whichever is longer. The operating cycle just means the company will buy a product, sell it, collect cash. That's the operating cycle. A company like Boeing, who takes a while to make jets, may have a longer operating cycle. So asset size, you can see here current assets, long-term investments, property, plant, and equipment, intangible assets. On the liability side, you have, and shareholders, you have current liabilities. Again, they have to be paid within a year. Long-term liabilities, paid longer than a year. And the equity. Here is a more extensive classified balance sheet. Now these assets are usually listed by liquidity. And so for assets, it's how quickly they can be converted into cash. So cash is, of course, cash. That would be your checking account. And then debt interest investments, in other words, you bought debt. So if you buy T-bill, then that could be a debt investment. Accounts receivable means you have extended credit to a company. So you've sold them a product and you expect them to pay you back, usually within 30 days. A notes receivable, same thing. You lend someone money, they owe it to you. It's usually longer than 30 days. Accounts receivable doesn't charge them interest. Notes receivable usually does. Inventory would be the products that you're selling if you're a retailer or you're a manufacturer. Supplies would be things that you use in your business that, let's say you buy office supplies and you don't expense the office supplies until you use them. And then prepaid insurance, if you pay your insurance bill for the year, then you've created a prepaid asset. You could theoretically cancel, you could sell your car, do away with it. So once insurance is something that because of time you will use. So if you start the year with insurance for a year, that's an asset. You have 12 months of insurance. After the first month elapsed, you now have used that, and so that is an expense, but you have now 11 months of an asset. And again, every month that you use it, that declines. Long-term investments, again, you're going to convert them to cash longer than a year. Long-term investments could be stock. You could buy stock with the intent of holding onto the stock. You could buy real estate with the intent of holding onto that real estate for longer than a year. Property, plant, equipment would be anything that has a life longer than a year, has a physical presence, and is usually used in your business. So land, if you are Walmart, you may have bought land for all of your stores. You have equipment, which would be all the computers, all of the shelves, all of the um, baskets. Uh, and then because you usually buy something that lasts for more than a year, you have to account for the fact that over time, these assets no longer have the same value. Your car, you use your car, and your car does not typically gain value, although the last couple of years that's somewhat changed. But typically, a year after you bought your car, it's worth less. And so the difference between the what you paid and the value at the end of the year really is called depreciation. And for a company, we're going to depreciate these assets over a certain amount of time and usually in a logical way and a consistent way. And so your asset is going to be the net between the cost and what you've depreciated it. And then you have intangible assets, which in Nashville is very important because they would be things like copyrights for songs, patents, trademarks, things like that. These are, you can look at the song and you can look at the words on a piece of paper, but the song itself really is the asset. So it doesn't have the same physical presence as a property, plant, equipment. So, all right, so that's the asset side, and this side we have 61,400 on for this example. And so again, assets equal liabilities plus equity. And so liabilities again are separated into short term and long term. And you see that these assets of 61,400 are equal to your total liabilities of 27,350 plus your equity of 3405. So assets equal liability plus owner's equity. Now, in accounting, usually when we put into accounting system, we have what's called debits and credits. A debit just means a positive number, and a credit means a negative number. And like assets normally have a debit balance, liabilities and equity have a credit balance. So that when you actually add these two together, every time you update information into your accounting system, they're going to net to zero because you're going to have as many positive as negative. If it doesn't net to zero, then you have an issue. And yes, I'm a Georgia fan. All right, so current liabilities, notes payable. That just means that we bought something from a vendor, and now that vendor expects us to pay them. Notes payable, again, are longer. Usually they're after accounts payable. Accounts payable, same thing. So when you say receivable, that is an asset. Payable is a liability. It means you're supposed to pay something. Unearned sales revenue might be a deposit someone gives us that we haven't actually done the work for yet. So it's a liability until we either do the work or give them their money back. Salaries and wages payable. A company will generate this because they have employees, the employee works today, but we're not going to pay them until maybe a week and a half later or a week from today. And so we have created a liability. We owe the employee that money. And so every day that amount goes up until we pay them, and then the amount goes down, and then it goes back up and down. So that's how that works. Long-term liabilities, mortgage payable. If you have a mortgage, you know that it's usually a 15 or 30-year mortgage, so that's obviously longer than a year. And again, notes payable is due longer than 12 months, so you have a short-term notes payable and a long-term notes payable, totally dependent upon the length of time when you have to pay. And in equity, normally you have a couple components. Common stock means that we've sold stock, we've sold the company. So we have sold shares of the company to someone. And the money that we collect at the moment we sell that is what is listed on our shareholder equity under common stock. And we'll break it down a little bit more than that later on. And retained earnings just means this is all the money we've kept in the business. So the income statement, again, is how much did we make? Now, if we made $100,000, how much of that are we going to keep in the business versus how much do we give out as dividends? If we made $100,000, we give out $30,000 in dividends, then our retained earnings, what we're keeping in the company, is the difference, or $70,000. So again, current assets operating cycle is the average time it takes from purchase of inventory to sale of goods and then to collection of cash from customers. Most companies, again, are going to be on a year. Here you see the common types. In the earlier illustration, Franklin had total current assets of 22,100. So current assets are listed by how much? By order of expected conversion to cash. Yes. Now, personally, again, these are some of the types of assets that you as an individual might have. Cash in your checking account, money market, cash on hand, prepaid insurance, and prepaid expenses. So technically, you have paid your tuition, I assume, but if you were to drop the class, then you would get some money back. So that would be a prepaid expense. Clothing, furniture, phone, computer, books, jewelry, car, boats, bikes, motorcycles. These are all assets. You can convert these to cash. They have a life longer than, these are longer term assets. Investment accounts. If you have a 401k account, if you have an IRA, and real estate. So if you own a house or land or apartment building or part of a house. Liabilities, it's usually going to be credit cards. So if you go out and even if you pay your credit card off every month, which you probably should because they charge an exorbitant amount of interest, until you make that payment, you have created a liability. You owe the credit card company the whatever you just charged. And payables, I don't know that a person would have payables, but hey, you might owe someone, a friend, money. That's technically a liability. Personal loans and mortgages, student loans. Student loans are a liability. It's something that you are going to have to pay back. So long-term investments, again, are things that are held for more than a year. Long-term assets is land and buildings that a company is not currently using in its operating activities. long-term notes receivable. Property and plant equipment, long useful lives, buildings. Chick-fil-A, if you go and look at a Chick-fil-A, you'll see that they have a building, they have tables, they have equipment for cooking, they have storage facilities, they have the land that facility is on. Those are all long-lived assets that they're used currently in operations. And again, I talked about depreciation. You allocate the cost of the loss of value. All right. So you use a machine, you buy a lawnmower, it's brand new, you pay $400. It may last, say, 7 years. So it really, if it's $400, then it's going to cost you each year 400 divided by 7. And after 7 years, it's no longer useful. I mean, hopefully your lawnmower will last you 7 years. And so you keep a track of how much you've uh, depreciated. Depreciation is an expense, and you charge that monthly. Accumulated depreciation is the total depreciation that you have expensed up to that point. And then your net book value is the cost plus the accumulated depreciation, which is a contra account, so it has a different sign, which is since an asset has a debit or positive balance, accumulated depreciation, it's a contra, so it has a negative or a credit balance. Again, intangible assets, these will show you later on. They're very valuable. Katy Perry just sold her music catalog for $300 million. That's a large amount of money. And that's her music catalog, her copyright. And so someone has bought the rights to be able to charge people if they want to sing her songs. All right, so patents and copyrights are what? Current assets? Nope, they have life longer than a year. Intangible assets? Yes. Okay, so prepare the asset section of Hoppins Corporation's classified balance sheet. Okay, so we've got cash, which will probably be first. We've got prepaid insurance, 2,300. We've got equipment. We've got debt investments. An investment would be, of course, that we bought somebody's debt. Again, you could buy debt in a corporation, inventory, accumulated depreciation, accounts receivable, trademarks. So we're going to put this all together. So the current assets are cash, accounts receivable, inventory, and prepaid insurance. So that's 7,600. Long-term investments or debt investments are 2,100. Property, plant, equipment is equipment, like I said, um, plus the accumulated depreciation, which is a negative balance. And so your net book value is the difference between those two. So we have net book value of property, plant, equipment of $8,000. And then we have trademarks of 4,700. Current liabilities, again, we have to pay those within the next operating cycle or a year. We've already talked about it. Accounts payable, salaries, wages payable. Also, the current maturities of long-term obligations. So for a mortgage, if it's 30 years, the majority of that is going to go for a long-term asset. But the amount that you have to pay in the next 12 months will be under short-term assets. And then again, long-term liabilities are things that you don't have to pay within a year. Now, why is that important? Well, think about this. If you have a debt that you have to pay, and let's say you have to pay $5,000. So if you have to come up with that in a year, how would you feel compared to, well, you have to come up with that in 5 years? And I think your gut feeling is that, hey, if I got 5 years, I'm not going to worry about it too much. But if I've got a year, I've got to come up with $5,000, and that's something I'm going to have to figure out how I'm going to do it. Where am I going to get those funds? Am I going to reborrow them? Am I going to use savings? Um, am I going to use, can I fund it with operations or my normal paycheck? So that's why we want to go, hey, it's really a matter of liquidity. And so it's a matter also of risk for that company. Which of the following is not a long-term liabilities? I think we just talked about this. Bonds payable normally is. Current maturities of long-term debt. Again, those mean they're due within a year. And then the equities is made up of investments that people have made to the business. So when you sell stock, then what you record on your balance sheet is what you sold it for at that time. And then the stock market is really not between the company, it's between individuals that are buying and selling shares of the company that have already originally been sold. So I have stock in Apple. If I were to sell that stock, I would not be selling it to the company, although that is possible. But typically, I would normally be selling it to another individual that wants to buy Apple stock. And so that really doesn't impact the company, other than the company hopefully will do well and they'll hopefully pay dividends. And then again, retained earnings is what profit have we kept in the business? All right, so match each of the account names on the next slides to its proper balance sheet. Okay, so salaries and wages payable would be a current liability. Investment in real estate usually has a long life, and so that's going to be a long-term investment. Unearned service revenue. So again, someone's given you money and it's a liability. You either have to do the work or give the money back. So that's going to be a current liability, most likely. Debt investment short term. A debt investment, again, is an asset because you're lending money to a company. So that would be current assets. Mortgage payable due in 3 years. Again, you owe people money, it's a liability. It's not due within a year, so that's going to be a long-term liability. And accumulated depreciation, that is property, plant, and equipment. Um, Service revenues, not on the balance sheet per se, but the end result is interest payable. That would be a current liability because we borrowed money, we have to pay interest. We haven't paid them yet, but they have earned interest. Goodwill, that is going to be an intangible asset. Depreciation expense would be, it's not really on the balance sheet, it's on the income statement. Retained earnings would be under stockholders' equity, and equipment would be property, plant, and equipment. Now, ratio analysis is used a lot in finance, and we use it to compare other companies, and we use it to compare year to year. If certain ratios go up, that's a good thing. If certain ratios go down, that could be good or bad depending upon what ratio it is. So the ratio is just expressed as a mathematical relationship between one quantity and another. And yes, a single ratio by itself is not meaningful. And even a ratio in one type of industry will not compare to a ratio in another type of industry. We're going to look at Walmart. Walmart is the biggest company in the world for revenue purposes. And so their net profit margins are not going to be the same as a company like Apple. Walmart sells a lot of just, groceries and clothing, vitamins, shampoos, light office equipment, automotive products, etc. So they sell just about everything, and they have the highest profit, so their margins are not as high versus Apple. They sell high-end products. They sell cell phones and computers. So their profit margins are going to be a lot more robust. So profitability ratios will just say you have some like if you're a merchandiser or manufacturer, you have sales, cost of goods sold, which is the cost of the product you're selling, and you have gross profit. And so Walmart has gross profit. And for them, because they're a multi-billion-dollar company, that's an important figure. And then you have operating income. And so operating income is operating income divided by sales. And it's really a measure of how much am I keeping after selling my product and after all the expenses related to selling that product. And then net income would be the bottom line. What is my net income divided by my sales? So how much am I keeping? And for a company like Walmart, it would be, I don't know, I think maybe 5 or 6 cents. Whereas Apple, it could be 25 cents that they're keeping. So for every dollar Apple sells, they may keep 25 cents. Every dollar Walmart sells, they end up keeping 5 or 6 cents. Liquidity, just the ratios of, short-term ability to pay a company, how much do I have in current assets to pay current liabilities? Solvency would be, how much of my assets have I used, or how much of my assets are funded by equity or are funded by debt. And Apple is a very profitable company, and yet they have financed 80%, over 80% of their assets are financed by debt. So that would be the equivalent of you buying a home and putting 20% down. So Apple's basically put 20% down on all of their assets. And yet they have huge cash flow. So here's a classified balance sheet, and we're going to look at liquidity, which is working capital. So it's just current assets minus current liabilities. If you have more current assets than current liabilities, then that's going to be a positive number. And so that means that you have more than $1 in current assets to pay current liabilities. So it would really be like for you, hey, how much do I have in the bank, cash, to pay what I'm going to have to owe for rent, for groceries, etc. So hopefully you have more than $1 to pay for every dollar current liabilities. But some companies don't. And then we have the current ratio. Same thing. So again, if you're over 1, you have a current asset of, if your current assets are more than your current liabilities, then the ratio is going to be more than 1. So again, if you have current working capital, which is current assets minus current liabilities, if that's positive, then this ratio is going to be more than 1. But if that working capital is negative, this is going to be less than 1, which we'll see with Walmart. And so here are all of the assets and liabilities, and they're just going to compute the assets. So total current assets is 6,700 for 2027. For 2026, it's 5,900. Current liabilities in 2027 is 4,100. 2026 is 4,700. So current assets minus current liabilities is 2,600. And working capital in 2026 is 1,200. So you can see that the working capital increased. So the spread between current assets and current liabilities has increased from one year to the next. And current liabilities, again, so in 2026, we had $1.26 to pay for every dollar of current liabilities. In 2027, we had $1.63 to pay for every dollar in current liabilities. So we are less risky, we're more solvent, we have an easier time of paying for those current liabilities. And so solvency, the ability to pay interest as it comes due and repay the balance of a debt. And there's some ratios that we'll look at. So we're going to have debt to assets ratio. So this is the same thing. All right. So